Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Behavioral Finance and Anomalies. The section goal is to understand the portfolio strategies and evaluation, and the module goal is to understand the concept of behavioral finance and market anomalies. Now we talk about behavior and predictions. Efficient market hypothesis makes two important predictions. Security prices probably reflect whatever information is available to investors, and active traders will find it difficult to outperform passive strategies such as holding market index. Tests of market efficiency have focused on the performance of active trading strategies, and behavioral finance assume investors are not rational. Behavioral finance relies on two key notions. First, widespread and consistent psychological bias in decision-making and limits to arbitrage. All standard risk-return models in finance assume at least the law of one price. The law of one price is an economic concept that states the price of an identical asset or commodity will have the same price globally, regardless of location, when certain factors are considered. The law of one price takes into account a frictionless market, where there are no transaction costs, transportation costs, or legal restrictions. The currency exchange rates are the same, and that there is no price manipulations by buyers or sellers. The law of one price exists because differences between asset prices in different locations would eventually be eliminated due to the arbitrage opportunity. The arbitrage opportunity would be achieved whereby a trader would purchase the asset in the market it is available at the lower price and then sell it in the market where it is available at a higher price. Over time, market equilibrium force would align the price of the asset. Conventional finance versus behavioral finance. In conventional finance, prices are correct and equal to intrinsic value. Resources are allocated efficiently and consistent with efficient market hypothesis. In behavioral finance, what if investors don't behave rationally? And arbitrages are limited and therefore insufficient to force prices to match intrinsic value. There are some bias in the market, such as framing, which is decision affected by how choices are described, mental accounting, which is a specific form of framing in which people segregate certain decisions, regret avoidance, the individuals who make decisions that turn out badly have more regret when the decision was more unconventional, and affect and feelings, which investors tend to choose stocks with high affect, driving up price while simultaneously driving down returns. A market anomaly in a financial market is predictability that seems to be inconsistent with theories of asset prices. It is deviations from the model, or there is something wrong with the data, since the model must be right. An anomaly is simply a sorted portfolio trading strategy that is profitable, even when adjusting for risks using the classic benchmark models such as CAPM and Fama French model. Common market anomalies include the small cap effect and the January effect, for example. A sorted portfolio must be sorted using a sorting variable. Depending on the context, an anomaly can refer to an individual risk factor, a panel-level firm variable that is used to construct an anomaly trading strategy. For example, firm profitability, and common risk factor, for example, a panel-level firm regression beta, constructed by regressing firm returns against a time series. Technical analysis attempt to exploit recurring and predictable patterns in stock price to generate superior investment performance. Price adjusts gradually to a new equilibrium. It means that changes in the determinants of supply and demand result in new equilibrium, price and quantity. When there is a change in supply or demand, the old price will no longer be at equilibrium. Instead, there will be a shortage or surplus, and price will subsequently adjust until there is a new equilibrium. In addition, Disposition effect is an anomaly discovered in behavioral finance. It relates to the tendency of investors to sell assets that have increased in value. It can lead to momentum in stock price. Next, momentum and moving average. The moving average is the average price over a given time interval, where the interval updates as time passes. The bullish signal signifies a shift from a falling trend to a rising trend, while the bearish signal signifies price series crossing from above the moving average to below it, representative of the beginning of a downward trend in stock price. Let's have a quiz for this material. Behavioral finance argues that A. Even if security prices are wrong, it may be difficult to exploit them. B. Even if security prices are wrong, it may be difficult to exploit them, and the failure to uncover successful trading rules or traders cannot be taken as proof of market efficiency. C. The failure to uncover successful trading rules or traders cannot be taken as proof of market efficiency. And D. Investors are rational. So, this is the end for this module. See you later.